we are going to have yet another new rearrangement, and that's my cue for the volunteers, by the way, to put on the 5 chairs on the stage, because we are going to have a very nice panel discussion. And Elena, would you mind if I introduce your amazing panel discussion while sitting in the chair? It's very comfy, I don't want to move. Okay, perfect. So, we're going to have a discussion about the early stage investment. And joining us on this stage will be the moderator of the panel, Elena Hloba, who is the head of partnership in Wolf Summit. Then, joining her would be someone you already met. Probably he already made an impression on you. That's the guy who always knows what to talk about. Every single person he meets, he always has something in common with. And that is Sergey Fedyushchenko from NVO Capital. Hi. Perfect. Next up, joining us, Michał Rzutowski from Igasi. And this guy really made an impression on me as well. I'm still looking for him in the audience, because whenever I was adding him to the agenda, I always looked at his glorious photo. And I'm so curious if our photographers will be able to make him even a better one, to make sure it's going to be a long-lasting impression for him. Next up, joining us is Bałaś Ślezak. We just had a very intense eye contact, and I probably already mispronounced your name, so you're going to have to correct that. Perfect. So Bałaś is the CEO of Vozify. And the last person from the panel, certainly not least, is Christoph Klink, who is the partner at Antler. So we will need a couple of moments, and we will be ready. See, I told you, look at the photo. So intense. We need to make it another one, maybe even better. All right. hard. There's not a lot of you, so let's, it's the quality, not the quantity that counts, right?
Thank you, Anna. Thank you for introducing this panel discussion. I'm very happy to be hosting the discussion about early stage investment. It's a broad topic, and actually when we had a call about it and talked about what we can discuss, we had a couple of topics. We basically had a lot of ideas, but we put it all in the plan. So I'm I'll be happy to moderate the discussion, and hopefully there will be some information, great insights from our panelists for the startuppers or for the people who want to start a startup, what to expect and what is it, what is the early stage investment. But first, I would like to, while everyone is pouring some water in the glasses, I want to introduce our panelists. You can see all the names up there, but still, I'm happy to announce that we have with us Christoph Kling from Antler, Sergei Fedushenko from NVO Capital, Michał Żółtowski from IGACI, and Balázs Slezak from Wozify. Did I pronounce your name wrong? Probably
Almost.
Yes. Probably yes. I'm so sorry for this. It's tricky. Can you tell how to pronounce it correctly?
Yeah, it's Balázs.
Balázs. Okay.
Perfect. Thank you.
Yes. I wanted to ask each of you to first introduce yourself. What's your background in early stage investment, and you know what just a small introduction, a couple of sentences about yourself. So maybe we can start with Christoph and then come back to this side.
Of course, pleasure to be here. Christoph, general partner with Antler. We invest around the globe. Out of 26 offices by now, have a little over 800 portfolio companies, and typically start investing at day zero of an entrepreneur's journey, which means we invest very, very broadly diversified. So we invest both in hardware as well as in software. We invest in B2B as well as in the B2C business models, and we invest across all sorts of ventures. Relatively significant portfolio in climate tech and energy, in health tech, in fintech, but also across various other areas such as cybersecurity, number of platform businesses, educational tech, legal tech, almost anything. At the heart of it is always very, very high conviction that the founders behind those companies are exciting and great.
Balázs, yes?
Thank you for having me. It's so big pleasure for me to be here. My name is Balázs Slezak, and I'm wearing two large hats in my life. One of them is I'm a very active early stage startup mentor and advisor, work with organizations like the Founder Institute, the European Space Agency, and the European Commission. And my other hat is I'm the CEO and founder of Wozify, which is a software engineering company building products for startups. So I have seen hundreds of startups up close in my career, so I'm really happy to share my learnings with you.
Hey, my name is Sergey. So I've been on the both sides of the journey, let's say. I had a startup, and we managed to get into one of the top accelerators in the world called Berkeley Skydeck. And yeah, I'm a huge fan of accelerator ecosystem, actually. Now I'm a partner at early stage VC. Actually, I'm founding partner, so basically we raised the fund. It's you know, by like Silicon Valley standards, it's considered micro VC. It's 20 million, but you know, overall it's you know, not that small. We invest mainly in alumni of accelerators. So this is our investment thesis. So I'm being I really like accelerator ecosystem, as I told, and yeah, I'm being consistent with it within my VC career. From technology focus, yeah, I have biotech background, but our VC mainly invests in AI and entertainment spaces. So feel free to ask me something afterwards.
Hello, everyone. My name is Michał Żółtowski. My relationship to seed investments is twofold, because I'm the president of the Chamber of Commerce, which reunites the majority of Polish venture capital funds as alternative investment funds. And many of those actually do invest on seed stage. So I think I would be happy to share with you some of our members' experiences and track record in terms of seed investments. And secondly, I'm managing partner at a law, accounting and tax advisor firm. So we We work on different M&As and VC transactions, many of those being at seed level. So we do see, identify some tendencies being very into the current practice. So happy to talk today and gladly reply to any questions later on.
Amazing. So thank you very much for the introductions. Now our audience knows who they are speaking from, and this is a very impressive introductions. First things we decided to discuss is the basics of the early investment ecosystem. Not everyone understands why invest in early stage at first. You could invest in it later. Why do it early? Anyone?
Yeah, I think I can start. It's a really good question, and a lot of people ask themselves, why. The truth is, it's always about money. So if you think that early stage venture capital investments are about like charity or supporting entrepreneurship, it's not true. It may seem that way, but it's not. It's mostly investors look at the early stage startup and they estimate the probability of how likely the startup will be acquired, because its IPO is something extraordinary. So mostly it's about acquisitions, and so that's what they think about, how many access they will get. So at first it seems like venture capital is really, and I don't want to ruin any kind of hopes and dreams, but yeah. Venture capital is pretty, I would say, pragmatic field. Yeah. So, but at the same time, it's really good for startups, because if you, and we will talk about this later, if there are certain criterias, and if your profile fits, you will be funded. That's it. So.
What's the perspective of venture building, for example, Balázs?
So, in my experience, early stage venture capital is a numbers game. So, in order to be successful in venture capital, investors need to invest in a large number of companies, because they know how great the failure rate is. And usually they are having the power law in mind, which means there will be some startups that will exponentially outperform all the others. So what they are looking for, in my opinion, especially venture capital, because angels are different. Venture capitalists in the early stages are looking for startups that have the potential to bring back the entire portfolio's value with multiples. So they are looking for high-risk investments that can bring in potentially like outstanding rewards. So this is what I believe.
Anyone else wants to share?
Yeah, what I think, actually, based on what you said, gentlemen, I think that above other things, early investment is very tempting, simply because of those huge cash-on-cash returns, which are obviously possible, but the experience shows that they are not very frequent. So I think that the temptation is, on one hand, to reach such great returns and to hunt the mythic unicorns, or not really unicorns, but like companies which valuation has grown by 10 or 20 or 30 times. But at the same time, it's extremely risky, and the number of failing companies and projects is very significant. So I think that the point is that the teams who are willing to engage on this, and the truth is that the management fees are not that high because of the value of the general capitalization of the funds, which would be rather less significant compared to bigger funds. So I think that those people, they really believe in what they do, and they think that their competences enable them to select the proper targets, and that they're capable of doing something other people are not. So I think this is very important in terms of understanding the purpose and the drivers that push people to engage on this very risky stage of investing, right?
I'd actually give a slightly more idealistic response to it. I think for me, it's the point in a company's life cycle where very few people can make the biggest difference. It all starts with the founders, obviously. No investor will ever make a business succeed, and very unlikely that an investor will make the business fail either. So it starts with the founders. Great founders will make all the difference in the world. At the beginning, there is nothing else but those founders. But then, it's about the first very, very instrumental hires. Once you are in a company that has 1,000 employees, adding another very instrumental hire is quite important. But once you are a company with 4 people, it's even more important to get the right people on board. And I think for us as early stage investors, the earlier we get, the more helpful we can actually be and the more instrumental we can actually be building deep and trusted relationships with the right founders. So picking the right people, working with them, and then helping them actually on those first couple of 100 yards of that journey is something that excites me very much, because it is really, there's nothing but the founders at that very point.
Maybe
something.
one more thing I wanted to add, since we were talking about ecosystem, and actually this question was about ecosystem, we probably need to mention players at least briefly. And of course there are accelerators, incubators, there are different grant programs, and my advice would be use everything, especially if you're not self-funded startup. I mean, if you don't have money. This ecosystem, I would say, like pre-seed and seed ecosystems, they are really evolved, and especially in mature venture capital areas like United States and, for example, and at some point United Kingdom, I would say. So really use it, and don't expect that the investments will come to you if you will be just building a product. So just try to use every opportunity you have with grants, accelerators, etc. Especially accelerators. I would say accelerators, the badge, alumni of Accelerator X, for example, is something that can make the difference and launch a business properly.
I just wanted to go to the next topic because Christoph has touched upon it. What about the help that startups get from VCs or accelerators or investors? What the startups should expect? Like, what's the thing that, what the things that you can give them?
So I can speak from the perspective of accelerators and incubators, and I believe that Sergey is extremely right. Is that first-time founders who don't have that much experience in the world, in the industry, or working in a job, for example, fresh out of university, I would advise to basically every one of them to go through some sort of accelerator program as well. As usually these programs are come together with some sort of mentoring or some sort of like tailored advice for the stage and the industry of the companies. And this can very quickly bridge the gap, in the knowledge gap that is needed to succeed in the real world, and not necessarily in the world of academia, in the university. So absolutely agree.
And about last thing about accelerators, probably we're promoting them, but yeah, you as a founder, you definitely should apply it even to top accelerators. Because the decision-making process of accelerators is strange. They sometimes like to diversify across the batch. For example, Y Combinator, the latest batch of Y Combinator, and we invest heavily in YC startups. It has like a lot of idea stage startups. It was surprising, but they decided that way. I don't know, the partners of Y Combinator. So it could be you. You could be in this latest spring batch, for example. Yeah, just don't think that you're too early. Apply every 6 months. Apply to Y Combinator, Techstars, different Techstars, 500, etc. So like apply to them and look at the feedback, go to interviews. Within 2 years, if you're not accepted, I will be really surprised if you really do it consistently.
And Antler, of course.
Yeah, Antler.
But do you want to promote accelerators because you want to start your own?
Well, maybe.
Let's see. Yeah, but what's your take on the question about the resources that startups get from VCs?
Okay, so it's funny, but from my conversations with startups, it seems like large VC firms, they don't actually help that much. So they can promise something. They have their limited partners have a contact book that is really good, but they are too busy. Like too many startups in the portfolio. Boutique firms are most likely to help. Accelerators not only help. They can I would say make the difference. So I'm pretty sure that probably my colleague from Antler can share more.
Yeah, I think very, very important. I fully agree. Kind of as a founder, whether you're founding your first business or your second or your third, take all the helping hands you can actually get, but do your diligence on those helping hands. Right? So actually, kind of fundraising is you're selling a part of your company, and you might as well figure out who the hell you're selling that part of your company to. So understand fundraising as investors doing diligence on you, but also you doing diligence on those investors. And I think kind of I don't think it's as easy as saying small ones are helpful and big ones are not. I think amongst the small ones there are some that are incredibly helpful and others that are, well, maybe not. And amongst the big ones, I think there's some that have a very, very positive and very accelerating effect, Y Combinator, for instance. And then there's a bunch of acceleration programs that are not incredibly helpful to you, right? So I think very, very important to understand that. I think one thing to keep in mind is always, and some investors will say that they almost become another co-founder, but they won't, right? So founders build businesses, investors don't, right? And that's good. I think investors are choosing a role, and that role is standing at the sidelines and hopefully being supportive and helpful for founders to be better at what they do. But in the end, you can't expect an investor to be building a business for you. You can expect them to be very, very helpful, helping you avoid mistakes that an investor has seen dozens of times, so you don't have to make them again, helping you kind of take some of the painful stuff out of figuring out some funky admin stuff, helping you figure out kind of which other investors to work with, giving you visibility, helping you in hiring. That can be very, very helpful if you're not very experienced in hiring, working with an investor closely on attracting and identifying the real best hires, I think is very, very helpful. And making good introductions at the right point in time, I think is also very, very helpful. And then there's some that kind of offer some technology partnerships to get kind of started. Access to kind of the big cloud providers, for instance, can be quite instrumental as long as you're not well funded, as long as you're essentially kind of around bootstrapping. I think all of these things can be helpful, but no journey is like the other, right? So kind of cloud credits are incredibly helpful for one venture and incredibly unhelpful for another one.
Yeah, I saw that Michal had some things to share.
Yes, because chiming to what my predecessors said about resources that actually early stage funds could offer to the startups, and I think this is a very important comment about the like smaller funds. They would be more, I would say, eager to engage into the operations of startups. And I agree that there is this borderline between what the investor does and what the operational team does. But sometimes I think, and especially it pertains to smaller funds, the borderline is not that clear and it's continuous and vague. And I think that because in the Chamber of Commerce, GASI, we reunite like more than 100 funds. So when I look at them and when I look at the funds which invest at a very early stage, I would say that the most successful investments are those in which funds are like a little bit like business angels, that there would be And that's what I said before, that there is, I think, very important synergy between competences of people in operating in the fund and startups. So they would really believe that they can help, not by certainly engaging into operations, but like, you know, helping obtain an important contract, or even like, you know, having an in-depth knowledge about a particular industry. So this is what basically what Business Angel does, and the money that they would bring is only part of the deal, right? Because, and I think that the main motivation for Business Angels is the belief that they're like synergical to what a particular startup does. And I think this element is very important in early stage investments for venture capital investors as well. So they would have this spirit of synergy with the startup. And I think it's important because when you look at smaller funds, as I said, their management fees would be less significant than big funds. So they would be more motivated for the success because they would, like, you know, receive their carry interest. And I think that you should not always, you know, look for big funds, but really for the synergy between the team operating a fund and your startup.
Yeah, connecting to these ideas and smaller funds and resources, I would like to ask you to keep in mind the idea of the power of specialization. Like, if you are not building a, well, I'm not saying traditional SaaS business, because if you are building a SaaS business, every VC will be your VC. But if you are building something special in some other industry, like space industry, biotech, robotics, like any kind of hardware business, it would be a good idea to first seek out those accelerators and those VC funds who specialize in your particular vertical, or have several investments already in that particular vertical. This is where the part of due diligence comes into play again. So if you do your homework and search for more investors, more VCs who are more suited to your particular business type, they will be able to provide you the much better industrial connections, further on investment opportunities than generalist funds.
And last thing, don't be shy, do outreach to the portfolio companies of your potential investor. It will give you really good understanding what you can expect.
Amazing. Coming to, so this is really good advice that I haven't heard some of the things before that you said now. One of the topics that we also discussed was the changes that in the early stage investment environment in the last 3-5 years versus now. What has changed from your perspective? Maybe we'll start with Christoph.
So I think there's probably two things. One is 5 years versus a year and a half ago, and then there's a year and a half ago versus today. So I think kind of in the medium to longer term trend, I think almost across the world we've seen a very, very strong professionalization of early stage investing. I think compared to 5 years ago, and even more clearly compared to 10 years ago, you'll see a lot more people that are running really, really very professional funds and investing into venture in the early days. And I think that is wonderful if you're a founder, because all of a sudden you have a choice. All of a sudden you can actually compare who to work with, and you have kind of a broader range of investors to draw onto. And I think that is very, very good news. That varies a little bit from kind of geography to geography, and I think also kind of with regards to how active business angels, for instance, are. There's some European governments that are very, very active in promoting that. The UK government, for instance, has some very, very, let's say, encouraging tax credit programs. The French government, for instance, is very forward-leaning. So kind of public actors across Europe are moving that quite a bit forward. I think when you then look at the last year and a half, we've put a lot of uncertainty into the market, starting beginning of last year. Probably not many more things could have gone wrong macroeconomically and kind of from a geopolitical perspective than they have from the beginning of last year. So I'd argue throughout the first 3 quarters of last year, there was a lot of uncertainty in the market. It was a little bit like the beginning of the COVID pandemic, where everybody said, what the hell is going to happen? Probably it's going to be bad. In the end, it wasn't. In the end, kind of it accelerated a lot of developments, and it was actually quite helpful. Led to a bit of a bubble maybe as well. But I think first 3 quarters of last year were very, very careful investing and much slower, in particular in later stage investing. So I think almost no IPOs, very, very few trade sales, and that has meant that into growth stage investing, so when you are actually kind of 5, 6, 7, 8, 9, 10 years old, that is kind of something where not a lot has happened. The early stage investing has remained much more resilient against that also over that time. So anything before Series A, I think very, very resilient. From Series A onwards, I think a bit more deeply impacted.
Anyone else wants to share the perspective, some insights?
So yeah, I believe that there were 2 large trends that has changed due to the COVID pandemic. Is that, for instance, in the US, before COVID, like 5 or 10 years ago, VCs wouldn't even touch startups that were not in the major startups hubs with like a 10-foot pole. If you are not in the Silicon Valley or New York or maybe Austin, you had no chance. But now the geographical diversification has creeped into the US, and it's a very good thing. So for instance, $100,000 very early pre-seed investment can go a much further along way in rural Wyoming, for example, than in the Silicon Valley. And VCs started to realize that, and also the same trend can be viewed here in Central Eastern Europe. I have seen a lot of strengthening of CEE funds. And the major startup hubs, of course, in Europe, London, Berlin, are still there. But these kinds of events show how strong the region is becoming slowly.
Just one figure to add to that. 10 years ago, there were about 40 cities that had kind of brought forward a unicorn company, so a company worth more than $1 billion. Last year was about 4 times as many. So really, venture and innovation has gone very, very global.
Yes. And the other trend that I have seen and I'm experiencing myself is the larger willingness from investors and VCs to put more money in deep tech. So normally they are slowly realizing that the low-hanging fruit years of simple SaaS businesses are kind of over. So in the SaaS business, you have to do something much bigger than just put up an MVP and hope for the best. So they are slowly realizing that with longer returns on investment periods, like instead of 3 or 5 years, they are expecting now 10 years returns and putting more money into deep tech. So I encourage everyone to seek out opportunities in this area, because 5 years ago, it was almost impossible to get like VC funding for these kinds of ventures. Only the European Union were willing to fund it, but now the situation has changed for the better. So I encourage each of you to seek out these opportunities.
Yes. Okay. Yeah. So I just want to chime in talking about deep tech, because I think this is something I wanted to mention as well. But I think it's a little bit complex, because generally when I talk about deep tech, I have this impression of this, Molière piece of theater, in which there was a protagonist who was like, talking prose, but he never knew that actually. And at some point he discovered that he's talking prose. And because we've been working with investors, investing in very complex technological projects starting from 2010, and no one called this deep tech at the time. So, but I think that the fact that this new, so to say, fresh notion was coined, deep tech, it is a sign of interest on the market in the projects which are like more complex technological, which would give more of, I would say, in-depth disruption than, you know, like SaaS products which are like easily, which, you know, whose road to the market is certainly easier, but they would, you know, could like face challenges at later stage of development. And this is related to what you said about, like, you know, a decrease in the financing of Series A and subsequent series. But at the same time, I think that we need to take into consideration the fact that the cost of capital has increased significantly, mostly in like last year and before, depending on particular, you know, central banks and interest rates, but I think this is an important factor. So what I would suggest for you as founders, if you could like imagine a startup which is a deep tech startup, but at the same time which has a direct and clear vision how to get to the market and to generate revenue in a foreseeable future, I think this is a sweet spot right now for many investors.
I'll try to be brief. From my perspective, one of the major trends is basically large firms are creating, they're starting to be more interested in, I would say, seed and Series A worlds, while previously they were really, really comfortable in their 1 billion plus spaces. So why it happens? Because there are not enough allocations on the later stages. The pre-IPO boom that happened, I don't know, like 18, 19, I think maybe 2020, right? So it created a specific demand, and a lot of asset allocators, like asset managers, family offices, wealth managers, they managed to negotiate certain parts of their portfolio to be invested in venture capital. But now they can't invest in later stages because there are no allocation. So they're going down. They're going to seed, sometimes, well, mostly Series A, but, you know, seed as well. I think it's a huge opportunity. So it's sometimes you can negotiate a deal with a firm that is not VC, for example, but still they're already investing directly in seed stage because they want allocations on further later stage rounds. So I think it's one of the interesting things to keep in mind.
Amazing. Thank you very much for your insights. The last thing for this discussion is to discuss what's going on now. There is a crisis going on. And we discussed that basically crisis is always the best time and place to start a startup. What's your maybe, you know, advice, thought on the crisis for the founders? What do you want to share?
So I think in times of crisis, you're either depressed or excited. I choose to be excited because I actually believe that it presents great opportunities. A couple of things that are much better today than they were a year and a half ago. One is access to talent, hiring. 2 years ago, it was, I don't want to say impossible, but very, very, very hard to hire. And with all the rounds of layoffs, which are all kind of an individual tragedy, but from a macroeconomic perspective, and for you who want to hire these people that formerly used to be at Klarna, that is very, very, very helpful. So I think kind of taking opportunity of talent that is freeing up, super, super helpful. Second one is in times of disruption, it's often going to be the case that incumbents, so companies that are already in the market, are more busy with themselves and actually making sure that they survive than they are with looking at you who's entering the market. So it may be an interesting opportunity for you to actually disrupt something because people are more busy with trying to do their own homework and focusing more on themselves than they're focusing on the market environment, which you are actually going to be disrupting. And I think lastly, you'll see that many, if not all early stage investors actually get that and keep investing, keep backing founders, and actually see that opportunity and want to shape it together with you. So I think it's a wonderful time. It's not one to be depressed, it's one to be excited about.
It's always your choice, right? Anyone else?
Yeah, so I would also encourage everyone to be excited, because one of the largest like big brands that are here, we consider them successful startups, started at the last big financial crisis after 2008, like Uber, Airbnb, Groupon, and WhatsApp. So these companies have changed the world, kind of. And this is an opportunity to do the same because of the macroeconomic environment, as Christoph mentioned. And also, this is the best time to do something, as some people would believe that, for instance, valuations are lower due to the more cautious nature of investors right now. And I believe this is also an opportunity to have more sustainable growth. It's like a lower valuation in a very early stage. Counterintuitively, I believe it's a good thing, because it's going to be more sustainable to raise further rounds.
So in terms of the crisis, I would say that I'm really on the positive side, let's say, because I see that the latest batches of accelerators we've been working with have pretty good rates of the rounds are closed within weeks. So it's compared to the previous batch that was really depressing, even for Y Combinator. Yeah, it's like I would say it's a pretty significant shift. And also, I'm looking at, for example, from limited partners perspective, the investors who invest in VCs, they also starting to invest after the last few years of being pretty frozen. You know, they're starting being more active. So yeah, I think that the next probably 2024 would be really good year, and yeah, so I hope that we are on this uprising trend, and the trend is going up. Another thing that I wanted to tell is that most of the people who are using the crisis, where they're trying to kind of get advantage somehow of a startup. So remember, it's your valuation is based on how much money you need to hit the next milestone. That's the key, and they can't lower your valuation because of the crisis. If you need 1 million to hit the next milestone, you can't raise 500. You will get nowhere. That's it. So just remember this and try not to fall in this trap.
Trying to be brief, so I think the actually crisis is just one of the factors you need to take into account while analyzing the current situation for startups. Because as I said before, certainly the price of the money has increased, and the statistics show that the tickets, even on early stage, the value of tickets has decreased compared to prior years. But I think that you need to take into account the significant changes related to, notably the development of the AI and the possibilities that it gives. So I think that using AI, actually any person on the globe is capable of building, MVPs and trying to get up with a product which without the need of more significant financing. So I think that along with new needs created by the crisis, needs and space for new products and possibilities to build them up without a need of very significant resources, I think it's a great opportunity for startups today.
It's amazing how many things startups would get out of this discussion. I specifically asked our agenda manager to give us 5 more minutes out of the time, because I was like, I need these people to talk more. I need these people to give more knowledge to the audience. If you have any closing remarks, because we are almost out of time, maybe one sentence, one word, one phrase, anything?
I'll start. Just be consistent with what you are doing, and don't give up. if you need to do one thing for a long time. Don't jump from one thing to the other every 6 months. That's I would say, from my perspective, this is one of the main things that lead to success.
Okay, my motto is always make something people want, which is my YC slogan. And what I advise all of you is to try to look for problems in the world and use technology to solve them. And while you are solving problems, you are going to be successful in the startup world and the business world.
I'd say, depending on where you are, either keep building, keep digging, keep going, or throw away very, very fast. The earlier you are, the faster you should throw away. If there is no positive validation for what you're trying to solve, if that problem isn't real, if not enough people care about that problem, throw it away. If you're 2 steps further and you know that people want that people need to solve that, keep digging, keep building. Although 100 of us might tell you no, go to the 101st and get the yes.
Same for me also, towards tenacity and openness.
Amazing. This is amazing note that we finish it on. Be positive. It's very the takeaway is be positive. Thank you very much to our panelists. A huge round of applause. And we will be rearranging the stage before the next Great Pitch Contest slot, so stay tuned.